Welcome to the November 2023 Monthly MOTR Checkup. My name is Dave Lundgren. I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. Before we begin, let's take a quick look at the disclosures. And once again, just as a reminder, we do manage a hedge fund here at MOTR Capital Management and Research. And so some of the names that might be mentioned in either in this report or in other reports are potentially securities that we may trade in our individual portfolios that we manage. Okay, cloudy with a chance of sunshine. So obviously the hope is that there's a new bull market on the horizon, but as it stands right now, there's still quite a bit of uncertainty and things that are just not in place yet for a traditional bull market to get underway. And I'll talk about what we mean by that. But the idea is that while we wait for the bull market to take hold and resume, we don't necessarily have to wait for that to happen before we take action. And the idea, though, is to be very careful with where we do position a portfolio bullishly at a time prior to when we actually have evidence that such a bull market is underway. And of course, we wrote about that all through October, the idea being that when the market gets oversold, then that is the best time and place to place the bet that the bull market will return. The worst thing you want to do is place that bet after the market returns back across the range and it gets overbought, and then get more comfortable in the view that things are getting better just because the market's overbought and kind of rallied across the range, and that gives you a sense of more confidence to go ahead and get long. But the problem is that you're now taking action at the top end of a range that it could easily resolve to the downside. So now that I've taken action and we've positioned the portfolio for the resumption of a bull market, the idea now is you just wait and see if the bulls can capitalize on this setup that they've been given, which was a very oversold condition into October. Can they translate that energy that comes from that oversold rally into trend change? And we don't have a forecast on that. Certainly have a preference. We'd love to see them do that. But if they don't, it'll be at that point when we get overbought across the range without trend repair that we will then take action in the opposite direction, reducing our long exposure and restoring our short exposure. So right now, as it stands, the evidence is definitely not sufficient to indicate that the bulls are back, but we definitely like what we're seeing at the margin. And then from a related markets perspective, we want to check in on oil and rates because both appear to be signaling potential change on the horizon for each. And of course, if that's the case, they will likely have an important impact on the broad market as well. Okay, so let's take a look at what we mean when we say the ingredients for a bull market. Typically, when you're in a bull market, you see the popular averages such as the S&P 500, which you can see up here on the top, and the hang on a second, let me just open up this here. So the bull market is the hallmark of a bull market is the popular averages moving in one direction and the breadth of the market moving in the same direction as well. So there are a lot of ways you can measure breadth. I personally believe that the best way to measure breadth is just to measure the market on an equally weighted basis. And that's what the value line geometric average does. By no means, I write about the value line quite a bit, but by no means am I saying that that the value line geometric average is a good representation of wealth creation in the market and in equities. It's in fact, I would emphatically state that it's not. That's what cap weighted indices do the best job of. But what they do, what I believe is the best job of, is identifying what the breadth of the market is. And you can see that when trends are apparently healthy and robust at the index level, that is only when breadth is moving in the same direction. And that's also true on the downside. When you have breadth moving, when you have the market moving in a bear market, breadth always goes in the same direction. So therein lies the conundrum that we have now, because we now have the S&P apparently on the verge of beginning a new bull market, with the average stock down at the most recently down at the October low. So nothing at all remotely approaching what's would be considered a bull market. Now, I want to stress this is by no means is it bearish. It doesn't mean this has to end badly. We've had divergences like this in the past. I've written about them. I think it was 2011 and 1994 where there was a big disconnect, and the market actually resolved higher. So I'm open to anything. The point is, be selective in where you're banking on this resolving bullishly versus bearishly. So if you're thinking this is going to resolve bullishly, the best thing you can do is do so while it's oversold. So more recently, drilling down to the current example where we can see clearly the S&P is trying to tell us one thing, with the average stock or the value line telling us something different, with once again right down at its October lows just recently from last year. The time and place to make your bets is when the popular averages and the breadth itself get into these support zones and get oversold. That's when you want to place your bet that things are going to get better, not after they rally. So the idea is to place your bets while it's oversold, cover your shorts, add to your longs, and then on that rally, should there be inadequate repair work being done into the overbought condition, then you simply reduce your longs and restore your shorts. If, on the other hand, we do identify adequate trend repair, then you just continue to hold what you own, and perhaps maybe you'll need to modify them to kind of catch up with what current leadership is. But for the most part, as I'll show you, it's kind of the same cast of characters that have been leading for over a year now. So when you look at from our trend model, this is the measuring the percentage of stocks across the 3 time frames. And what we can see, the good news is that now, for the first time in a while, 52% of the market is in a short-term uptrend. And I want to reiterate that when I say short-term, that's actually the weekly chart. So that's for many technicians, the weekly chart is the long-term chart, and the sort of medium-term chart is the daily chart, and then a short-term chart would be the hourly chart or something like that. So for me, because what I'm trying to do is capture fundamental trends, my short-term chart is the weekly chart. So to say 52% of the market is in a short-term uptrend is significant, because it is the weekly chart. So that is good. In that context, however, we still have the biggest trend buckets in the long-term and medium-term time frames. They're still downtrends. So the biggest trend buckets in the long term still look some variation of this or this. These where you have these lower lows and just clearly a bearish trend. Those are the biggest trend buckets across the longer term and medium term timeframes. And again, that's just not what bull markets look like. I'm not saying it won't change. I'm not saying it won't get better, but I am saying we do have a process in place to identify if it's changing or getting better. And as of this moment, we can see they're not inflecting positively. Absolutely. And that's what has to happen in order for the long-term trends to get better, is the short-term has to get better first. And we can see that it is. So that's definitely good. Some other good news that we do see, and something we've written about quite a bit, of course, is that when you take the same trend model, and instead of saying percent stocks, you say what percentage of the market cap is in each of these buckets. You can see that the biggest buckets across the timeframes for market cap is some form of uptrend. So this is definitely positive. There's no question about it. You can see that playing out here with the large cap S&P 500 having a much better trend structure than the average stock. So all of this comes together in this table, and you can see that playing out here. So another thing that we do think is constructive, and it's definitely on the side of the bulls, is that the biggest category of trend on the long-term quarterly chart is bases. So bases are just simply these 4 categories, right? Just add them all up and you get 54%. So most stocks are literally going nowhere. So in that context, when the market's oversold, that's actually a good moment to place your bet that things are going to get better. Last year, most stocks were not in bases. Most stocks were right here in this category. And so in that condition, when you're oversold, that is not a reason to go long at all. Is it a reason to cover shorts? Yes. But is it a reason to go long? No. This is different. Half the market's going sideways, half the market's trendless. So in that environment, I'm comfortable with taking a long exposure. And that's particularly the case today as well, where the monthly trends, 53% of them are also in bases. So there's a lot of basing activity going on here, which is very different from last year, where there were very few bases. Most trends are actually in a high momentum downtrend. And then when you look at with the whole notion of trends being fractal, the idea is that momentum has to get better first before trend gets better. And then across the time frames, short term has to get better before medium term, and then long term. So these are the two dimensions of fractal activity that we're watching for. In the very early stages, 54% of the medium time frame charts, which again is monthly, has positive momentum. Now we're going to want to see this get more extreme. We're going to want to see it get in the studies that we've done back to the 50s and 60s using this model. It gets up into the high 70s, high 80s to demonstrate high momentum in this new bull market. And you can see here in the short term, it's currently 83%. And that's something that, again, it's fractal. So the fact that it's 83% on the short term is very good, but that needs to translate into similar degree of momentum on the medium term in order to indicate that the lows are in, and that we can actually bank on the idea that this whole basing structure that we've been following for 2 years now is going to actually resolve to the upside. So something we've talked about a lot and amazingly continue to see play out right now is that despite all of this, really, frankly, a bear market and followed by a 2-year range, despite all of that, the leadership has remained very cyclical. And I think when you think about what the core essence of trend following is all about is valuing the opinion of the market on the assumption that the market is looking forward, being the best fundamental analyst on the planet, is looking forward and likes what it sees if the cyclical sectors are leading. And that has been the case for at least a year. And so that's I think one of the most constructive things that we can point to in terms of how the market's behaving. And then when you look at the trend structure within each sector, we can see that almost every sector has a majority of charts in a short-term uptrend. Note, however, that the energy sector is one of them that is not, and we'll talk more about that in a moment. But we also want to note that looking across the medium-term and long-term timeframes, again, even by sector, most sectors are in a long-term downtrend of some sort. Could be a base, could be a clear downtrend, but nonetheless, it's certainly not in an uptrend. So that includes technology, which most people would probably think that the majority of tech stocks have to be in an uptrend, but that's clearly not the case here. So again, none of this is to say it won't be, but it is to say that because it's not yet, you don't want to be chasing this market higher into the next overbought condition, because what you could be buying into is an overbought downtrend. So the idea is to place those bets when you're oversold and at support, which was what October provided us with. Now, when you look at the same analysis and go from sector to industry, we find again that the industry leadership is literally a who's who of past bull market leadership. And when you look at the sectors, the percentage of stocks in an uptrend, we can see it's clearly almost every industry has a very high percentage of short-term uptrends, but it also plays out across the medium term and long term at the industry level. So this is very healthy, very robust leadership. And so we definitely like what we see here. So taking all of this and putting it into one single sort of conclusive indicator, where we're looking at price trend, momentum, relative strength, breadth, and volatility. Mash that all together into one gauge. We refer to it as our risk gauge. And what we can see here is that it's getting a lot better. It's not, by no means, as I've said, it's not registering bull market activity yet, but if it's going to, the whole premise of our research process is it being systematic and tied to things that must be, these inviolable rules of trend following. The bull market cannot resume until these things happen first. And so what we do like is that all three of these timeframes have ticked up. So once again, this trend timeframe here has to get into risk on before we can really indicate that a bull market is underway, but it can't get to risk on until the short term does so first. And we know that if you follow this closely, not too long ago into the October lows, the short-term risk gauge was down here at 9. And so it's made a tremendous move off the lows, which is something we anticipated it would do coming off that oversold condition. And the question was, can it translate that oversold condition into a risk-on condition in the short term, which can then set the stage for spilling over into the medium term and then eventually the long term. So clearly hasn't done that yet, but what we can see is that it's certainly making that effort. And at this stage of the game, we do like what we see. We're just not ready to call the end of the bear market just yet. So as we move across the range and get into this overbought condition, we're going to want to see an extremely overbought condition. So I think right now, if we can experience an extreme momentum on the upside, at the same time we see an improvement in the percentage of stocks in an uptrend, that's what we're going to want to see. So this is at this stage of the move, we don't want to be concerned or afraid of overbought conditions. We want actually as overbought as we can possibly get, because that's what we need to inflect trend to the upside. So we'll be keeping an eye on this as we move forward. And then the other thing we'll keep an eye on is the versus the 200-day moving average. Right now we only have 47% of the market above the 200-day average. In a robust bull market, it's going to be 85-90%. So clearly we're nowhere near there. And then also the percentage of stocks with a rising 200-day average in a robust bull market, it'll be well north of 70-80%. Currently it's at 36%. So clearly a lot of work to be done here. But another way to think about this is, by no means is this bearish. Every bear market looks like this when it's over, when it ends. And if indeed we do have a bull market that lies ahead, then the fact that there's so few instances of extreme trend behavior tells you exactly how much bull market activity lies ahead. So the fact that it's so kind of lethargic and not extreme yet is actually bullish, because it means that we have this large pile of wood that we have yet to even light fire to. So the way it is right now, it's clearly not indicating bull market, but all these inflections across the board that ultimately spill into the risk gauge, and we now starting to see the risk gauge inflect higher. All of this is good, and so now we just need to monitor and make sure that it continues to play through, and we see this all spill through into trend structure changing. So quality factor is probably, of the factors, it's the one that's most consistently generates alpha, and we can see that here. Obviously, during COVID, when COVID actually hit, the quality factor went vertical, not surprisingly. But also when the world was clearly not going to end, the quality factor plummeted. But since then, it's kind of restored its uptrend in frankly its long-term uptrend. So at the margin, particularly until we see clear indication of a bull market, I would continue to favor quality stocks over low quality. Obviously there are a lot of ways to measure that, but I think until we see the bull market truly engage and truly get underway, which is an environment where you could actually see low quality stocks work quite well. Until that, we want to favor quality. So for those that are interested, this is a list of names that rank well in our fundamental quality rank, and in this model, it's pretty straightforward. It's simple. Inputs such as returns on capital, gross margin, debt to equity. There's some revenue growth included as well as the volatility of the individual stock as well. So all these things come together to come up with a quality measure. And what we're featuring here is just 20 or almost 40, maybe 50 stocks that are in the top quintile for fundamental quality that also currently have strong trends. And again, this was just that was, as I just described it, is the screen, and you'll notice that almost all of them, in fact, all of them come from the leadership sectors. So here's an interesting, attractive set of stocks that rank well from a technical perspective as well as a fundamental quality perspective. Okay, now I want to spend a little bit of time talking about crude oil. and it may also spill into what happens with rates as well, depending on how much it affects core inflation. But when oil bottomed after COVID, one of the hallmarks of that bottoming process was that as crude bottomed, relative performance of energy relative to the market, which you see here, did not bottom. It went to a new low. That's a bullish divergence, very characteristic of a bottoming process. And we know that the same thing happened at the peak, where crude oil did not go to a new high, but relative performance of energy did. Again, pretty clearly and cleanly indicating a market top. And we know at the bottom, we had a nice head and shoulders bottom on the relative performance of the energy versus the market. And that, of course, that played out, more than exceeded its target, et cetera. Unfortunately, we have the same thing unfolding in the other direction right now. So it's not clear to me just yet if lower oil prices will be good for stocks, broadly speaking. I'm obviously leaning in the direction that will be the case, especially if it does spill over into sustained lower core inflation. But nonetheless, we can say for sure that lower oil prices will not be good for energy stocks. And as I said earlier and indicated earlier, the energy sector has worked its way down our ranking process for a couple of years. I think it's been in the top 3 spots, oftentimes for sustained periods, number 1. It's now at number 5. And notice how it's the only cyclical sector that is not really participating off the lows here in terms of percentage of stocks in a short-term uptrend. So something to keep in mind. We've taken action in our portfolios to lower our overweight to the energy sector in favor of these other sectors that we feature here. So definitely not calling it quits on energy, but we definitely want to make sure that, for instance, oil holds above 75. Relative performance doesn't take out these lows in through the June-July period. And if they do, then we'll just replace it with other cyclical leadership, because clearly there are alternatives to energy. And then finally, just a quick take on what's happening with rates and what it might mean to the equity market. This chart comes from a note that I wrote earlier, but the idea is that this relationship between rates and stocks, interest rates and stocks, is not stagnant. It's not a stale and certainly intuitive relationship all the time. So what we're doing here is we're just measuring number of weeks in a row where the correlation was the same as the week before, meaning directionally. So this is just showing you that the streaks of correlation from the 1970s right up until about 1998, the streaks of correlation were very consistently negative. So whenever interest rates went up, the stock market went down. And whenever interest rates went down, the stock market went up. And we believe that is because during this period, what the market was most concerned about was inflation. So any sign of inflation, i.e. higher interest rates, was bad for stocks. And of course, the whole world, from an economic standpoint, transitioned from inflation or reflation towards deflation or towards deflation. And that happened right around 1997, Asian contagion, long-term capital management, and the internet bubble, et cetera. In that transition, correlation between interest rates and the stock market actually went positive, which was a real head scratcher at the time, of course, because that just didn't intuitively make sense until later we discovered that what the market was trying to tell us, in its infinite wisdom, being the best macro strategist on the planet that it is, was trying to tell us that there's a wave of deflation coming. And so any sign of deflation, which of course is very bad for financial assets, any sign of deflation is bad for stocks. So whenever interest rates went down, the stock market went down. And whenever interest rates went up, indicating less concern about deflation, when rates went up, the stock market went up. So the streaks in correlation were consistently positive. And what I'm pointing out here is that we just had our longest streak of negative correlation in the last 20 years. So it's possible, and it wouldn't be surprising, I suspect, that the market is transitioning back to what most people would perceive to be a normal arrangement, where higher interest rates is bad for stocks. And so it's conceivable that that's what we're seeing taking place here. Now, if this were to play out, this is obviously very important for pricey, high valuation stocks, because this relationship between interest rates and valuations is also potentially inflecting. So what I'm showing here is the yellow line is the 10-year yield, and the blue line is what's referred to as earnings yield, which is simply just taking the PE ratio and flipping it upside down. So instead of P divided by E, you're doing E divided by P, and that's giving you the earnings yield, which is a way that you can now compare the stock market's valuation to the valuation of the bond market and how they move together. And you can see that from the 1970s right up until, again, roughly 2000, the correlation between the two was positive. So when interest rates went up, the earnings yield went up, and vice versa. So when interest rates went up, the bond market got cheaper, but so too did the stock market. And then conversely, when the interest rates went down, the stock market got more expensive. I'm sorry, the bond market got more expensive, but so too did the stock market. And you can see that roughly at the same time as this chart flipped as well. And so now we had the situation where when the bond market got more expensive, i.e. interest rates went down, the stock market got cheaper because of the concerns of deflation. And it's possible, this is the longest streak, again, back to 1999, of positive correlation between the two. So if interest rates are indeed on a new track higher, that condition would be particularly bearish or negative for a headwind, we'll call it, for pricey, high valuation stocks. So drilling down to the 10-year yield itself, we've featured many times, as have many others, the 40-year bull market and bond prices, bear market and yields reversed almost through right around 3% is where the yield actually broke a 30 or 40-year downtrend. So now we can clearly say that the trend is higher for rates. So now moving forward, obviously we're going to have our ups and downs, back and forth within that context. And I think it's fair to say that we probably do have a setback or near-term peak in yields, with a risk of yields going down to the 410 to 435 area. That should be, if indeed the correlations have transitioned in lower rates is good for stocks, that should actually be good for the stock market, adding to the vigor off of the October bottom for stocks, and maybe further benefiting the market as the Santa Claus rally plays out into the end of the year. For the trend of yields to actually inflect back down to the downside again, we would, at least as it stands right now, we would need to see yields get probably through 410 on the downside. But in the meantime, getting down to the 410 to 435 area is the likely outcome in the near term. And as that unfolds, it's very likely that we'll see the 200-day average, which is this red line here, work its way up into that zone of 410 to 435, further fortifying it against any declines in interest rates. So we think this is going to be a pretty strong zone of support for yields, which of course is something that the stock market will actually have to contend with going forward if we can't get through 410. But nonetheless, in the short term, in the near term, as we're trying to monitor how the stock market behaves relative to rates, and if the stock market can convert some of this latent energy resulting from this oversold condition into positive trends, this is the most important level for yields in our view, 410 to 435. Okay, so just in summary, as we have for a while now, we like the cyclical nature of current market leadership. It's astonishingly consistent, and the market appears to be saying to us that looking out into 2024, it likes what it sees. It's not nearly as concerned about the macro backdrop as certainly macro strategists and other aspects and other features of the stock market might indicate. That being said, we still want to favor high quality ideas for now. During this rally off of the October bottom, our view is that the bulls must convert this energy into a significant percentage of uptrend. So we have all this basing activity, as I said, over half the market's in a large now 2-year base. What we need to see is this oversold rally transition a significant percentage of those bases into uptrends. If we're unable to do that, then we will have only simply gone from an oversold base to an overbought base, which is it's not necessarily bearish, but it's definitely not a spot where you want to place bullish bets. And if anything, reduce your long exposure and restore short exposure if you're capable of doing that in your mandate. Our personal guess is that we do go higher into 2024, but the time and place to place that bet was back in October. And so when the market was down to the lows of its range. So now we just wait and see. Can we translate and transition these bases into uptrends as the market works through its Santa Claus rally into the end of the year and works off this oversold condition? And then, of course, between now and then, what crude oil and interest rates do will end up being key drivers for 2024 as well. And of course, all of that will work its way into our research as we continue to cover both. And that's what we have for you this month. Thank you so much for tuning in. I hope you found it helpful and useful. As always, if you need to reach me, you can certainly send me an email, which you can see down here at the bottom of the page. Thanks again, and we'll speak to you next month.